Hello and welcome to a brand new show of Market Makers. In the month of May, sell and go away. So far that thesis has not worked out. But if I map how the year 2016 has moved, it's been a year of twists and turns and peak and turfs. The year started with a lot of promise, then we saw gut-wrenching fall, a monster recovery, and now markets are perhaps hanging on to some basic liquidity cues. But where do we go from here? If Indian economy indeed has healed, is it a good time to invest, or the valuation comfort after the recent rally in this market is missing? So let's discuss themes, ideas, and where markets are headed with someone, with a very special guest, someone who's been a very consistent stock performer or a fund performer and has this art of picking great businesses when they're available cheap. Allow me to welcome Chirag Setalvad, Senior Fund Manager HDFC on the show. Fantastic to have you back. Thank you for joining us. I'm talking to you after 3 years, so it's important to take the clock back and really understand and assess your market view first.
Sure. So today the market looks reasonably valued, more so when you look at large caps, not as much when you look at mid caps. So market trades at 14-15 times 1 year forward earnings. And I think it's important to keep in mind that earnings have disappointed last 2-3 years. We've been at close to single digit compounded. So we need to get back to a more normal rate of growth, which is closer to 15-20%. So I suspect next couple of years, the near term may be challenging, but the next couple of years you should see reasonable growth. You should get back to maybe 18, 20, 25% growth over the next couple of years. So even if PEs were to remain where they are today, there's a reasonable opportunity to make money just from earnings growth. That's true more in the large cap space. In the mid cap space, valuations are a bit more challenging. So in the large cap space, 14-15 times 1 year forward, you're close to average earnings, average PE multiples. But when you look at the mid cap space, PE multiples are 15-20% higher than their historical averages. So we think that today, in general, you are better off in large caps than you are in mid caps.
That is coming from someone who is being identified as a mid cap stock picker. That's true.
But nevertheless, I think you have to call a spade, and today we are seeing greater opportunities in large caps and in mid caps, and a lot of money in the last year or so has come into the mid cap category, a lot of interest from domestic investors, HNIs, and that has held up the mid cap part of the market, and we've not seen any outflows really. So far dips in the market have been associated with inflows, so the mid cap category has held up very well. Mid caps used to trade on average at a 15% discount to large caps. Today they trade at a 10% premium to large caps. So I think keeping that in mind, I think it's prudent to be more oriented towards large caps. That doesn't mean that the long-term prospects for mid caps is not good. So there we remain very positive. It's more when we're talking about from a near-term, say a year and a half standpoint.
So if typically the tail is wagging the dog, it's time to blow the whistle then?
I'm not sure. Well, you look at the skew of market capitalization. So top 60-70 companies dominate market cap. So if those do well, then the market will continue to do well. So in that sense, the dog will wag the tail, not the other way around.
Typically when you invest, you don't only look at macros. You are not focusing on global cues. You look at individual companies, individual businesses. So is stock picking getting slightly tough in this kind of a market because everything is priced to perfection? And Indian markets, I mean, this entire perfection which has kicked in Indian markets in last couple of years is making life or job slightly difficult for you?
Much harder. Obviously, when valuations move up, it becomes much more challenging to identify individual ideas. There's a lot more competition, a lot more money. So today, if you have a list of buy ideas, that list has become shorter, and the sell ideas, that list has become longer. And you have a portfolio to create, keeping in mind risk parameters, and it's becoming harder to do that in this environment. Nothing like a falling market, nothing like a bear market, because while you may not see inflows, there are a lot of opportunities, and you can really create a high quality portfolio of companies which are well managed, well priced, well run. Today that's becoming extremely difficult. You can get well managed and sort of good businesses, but they're not available at prices where we are comfortable. So it's becoming more and more challenging to maintain a good quality portfolio while at the same time keeping valuations at a reasonable level.
Before we get into themes, businesses, and even the basic investment framework, what would be your message to your unit holders? I mean, your unit holders currently have investment in mid cap, they have investment in balance fund, they have investment even in large cap schemes. How should they reorient their investment considering that the margin of safety now is greater with large cap stocks?
I think the problem with most retail investors is they don't look at the big picture. So I think investors must keep in mind that 80% of returns is driven by asset allocation. So people are still focused on when should we get in, when should we get out, which fund should we pick and which should we sell. But 80% of returns is driven by how much you have in equities and how much you have in fixed income. And if you take a step back, it's how much you have in risk assets versus in low risk assets. I think investors must look at that first. I think that's the most important decision, which is not given enough of attention. The second is I think investors should put in money periodically. So we talk a lot about SIPs and it's very fashionable to do that, but I don't think people still give it its due weightage. So there is a desire to get in at the bottom, get out at the top and keep replicating that. It's a much more exciting way of investing, but it's not necessarily more rewarding. So
is that your experience as well?
Absolutely. So I think keeping asset allocation in mind, investing regularly, and as and when the market were to go through a significant correction, putting in chunky money. I think if one were to do these three things, it doesn't matter as much which fund you are in or which stock you are in. I think these are the three key drivers for returns and people give it very little weightage.
Let's talk about one of your flagship schemes which you manage, the mid cap fund, HDFC mid cap fund. I mean, nearly $2 billion now, almost $2 billion. If I scan through the top holdings or the key holdings of that fund, you've taken a disproportionate bet in the NBFC space. Pharma space is suffering, but you've got a decent exposure there. A little bit of exposure is also there in banks. So let's first start with NBFCs. The call has worked for you, so my compliments for that. But what is the way forward for NBFCs and why do you still like it?
So a little bit more apprehensive on NBFCs today. When we bought into these companies, they had very good ROEs and their valuations were not reflecting that. And they were growing well, good management. Today that situation has changed a bit because they have delivered in the last couple of years and they've got a lot of investor interest in the last couple of years. As a result, valuations have moved up from what used to be 1.5, 1.8 times book value to now 2.5, 3, depending on which company you take. So today, the case for owning NBFCs is becoming a lot more challenging because NBFCs now trade at valuations at par with large private sector banks. Both have similar ROEs, which mean over a period of time, they will grow at broadly similar paces. So do you rather own a large cap private sector bank which is growing at 25% where there is significant liquidity, or do you own an NBFC which is also high quality, similar ROEs, which means similar long-term growth, but where liquidity is quite different? So I think the case today for NBFCs versus private sector banks has come down in favor of private sector banks.
The risk for NBFCs is not business, it is valuations.
It's much more valuations.
Pharmaceuticals, I mean your top holdings, and we are not getting into a stock specific conversation, but Aurobindo Pharma, that has worked like a charm for you. Torrent Power right up there. Pharma space is in a complete disarray. A, pricing power is going. B, US FDA clampdown is making sure that these companies have to reboot themselves. What are your thoughts on pharma?
So I think unfortunately we categorize pharma into one block, but companies have very different profiles. So I think first we've got to keep in mind that different companies have different exposures to geographies, including the Indian geography. So not all companies are equally exposed to India or the US or developing markets. So I think it's easy to paint companies with the same brush, but actually their profiles are quite different. Even their manufacturing capabilities, their focus on quality is different. So the good news is that people look at pharma, they see the same concerns, and therefore they sort of think and evaluate companies in a similar fashion. But if you dig deeper, then you realize that different companies have different profiles, different sort of risk metrics, and as a result there's an opportunity, if you're stock specific, to pick reasonable ideas. So I think not only in pharma, it's true in pharma, it's true in IT, it's true in industrials. The key certainly in mid caps, but possibly otherwise as well, you have to be stock specific because companies have very different profiles in the same sector.
Markets, they always vote for one simple thing, which is rate of change. And if we discuss what has happened in the past, it is like saying that we are doing rear view driving and money is made when you look forward. So where are you confident of better growth and better days?
So in general, we are quite positive that the economy will turn around. Now, there has been this expectation for almost a year and a half and it's not panned out. But as you see on the ground, indicators have certainly turned positive, whether it's in car sales or cement sales. So you're seeing economic prospects beginning to improve. So over the next couple of years, I think two parts of the market will stand to do better. One is those which are economically sensitive, which means to some extent banks and to some extent industrial products. Those are the most economically sensitive, and construction in the similar vein. So those are segments which should do well. I think the other segment which should do well is where valuations are bombed out. Now again, that's true in banks, not so true in industrials, but it's also true in commodities where you're seeing a lot of value on the table. So I think either where you see companies benefiting from the economic recovery or where valuations are sensible, I think those are the two broad areas which look interesting. But I think again, having said that, the key in this I think is to be specific, focus on companies and look at the individual profiles, because within banks there are companies that we would like and not like in a cheap sector. Similarly, in an expensive sector there will be plenty of things that we like and don't like. So I think it's important at the expense of repetition to look at individual companies.
But in general, earnings recovery has disappointed. Even though the macro has been near perfect, we've got rate cuts, crude prices have come down, the benefits of a decline in commodity prices, that is now visible. But earnings generally, they have been slightly slow. Barring 2 or 3 pockets, the pickup is not there. So why do you think markets have gone so wrong in assessing the earnings recovery?
So as you said, the environment is very fertile. All the ingredients are in place. The problem is, this is not like baking a cake. It's not that you put in the ingredients, put it in the oven, and you know exactly when to pull it out, right?
Do you bake a cake, or you don't like to bake?
No,
a cake?
I don't. So I think all the ingredients, you're right, are in place. And the interesting thing of markets is that it's not clear how long it will take for the cake to get ready. So
for
sometimes
someone
it takes
who's waiting on the table, how much more they should wait for the cake?
In my mind, people investing in equity markets should have a minimum of 3 to 5 years investment horizon. Anything shorter than that, I think, is not suited for equity. So I think that kind of horizon is reasonable. And from here on, 3 to 5 years later, I suspect investors will do quite well.
At a time when interest rates are coming down, and since equity return at the end of the day is a premium to the average rate of return, the premium to the underlying interest rate. So if its interest rates are coming down, do you think the equity returns now in future will also come down?
No, I don't see. When you look at it from an extended time horizon, when you look at it from a 10-year perspective, I think those rates of return tend to be quite stable. So longer term investors tend to make 15-17% type of returns. Those returns are very stable. But in 2 year, 3 years, obviously in 1 year buckets, returns are very volatile. We've seen the market giving a 300% return and a minus 60% return since the inception of market. So 1 year returns are obviously very volatile. But when you look at 2 to 3 year buckets, I think from that standpoint, next couple of years should do reasonably well, because earnings should pick up. Now, will it pick up in the second quarter, the third quarter, or the fourth quarter? Is difficult to time that. But I think the environment is positive. Earnings growth should pick up to bring the averages back to a more reasonable level. Last few years have been at single digits. I think next couple of years, barring the next 6 months, growth will come back reasonably strongly. And today we forget that capacity utilization is also tightening. So the advantage and disadvantage in India is in building capacity. So there's not been meaningful capacity build up in the last couple of years. So as and when utilization builds up, there's a lot of operating leverage in the system. So I think we'll do reasonably well from a 2-3 year time frame.
The general ledge on which markets have rallied, and the feeling of optimism is coming because government spending has gone up. They're trying to fix all the bad sectors like road or railways, or for that matter power. If A, that is one assumption. B, the private sector right now does not have the ability or the balance sheet to kickstart a new economic cycle. So is it right to assume that for the moment private sector will actually lag the economic recovery?
I don't think it's as simple as that. I think the first point is that the government spending can't pull us out of any malaise on its own. Because if you look at government's share of consumption, government's share of investments, it's not as significant as one would expect. It's 20-30%. So you need private consumption to pick up. And I think that's partly a factor of sentiment. Corporate spending is a large factor, is largely driven by sentiment. It also depends on private consumption, individual consumption. So things like the monsoon, we have 2 bad monsoons back to back. And now hopefully we'll have 1 reasonable monsoon. So I think that has really hampered consumption as well. And 65% of India's population is agrarian. So I think government spending will help, but we also need to see the consumer coming back. And I think that should happen with a better monsoon. You should also see private sector capex coming back, and that will be a function. The private sector will look at government spending, they'll get a little bit more confidence hopefully, and they will spend a little bit more. So, and also capacity utilization will become a factor, and people will have to put in first in brownfield, then into greenfield. So you will see all of these factors sort of coming together. So I don't think the government can save us, but they can be a big enabler. They're also putting a regulatory framework which is a lot more positive. So it's not just government spending, but government creating an environment where companies get more confident, both Indian companies and foreign companies.
So the cake is in the oven, temperature is right, you don't know when the cake will come out. I'm going to skip and talk about from pure equity to what is your understanding of the interest rate cycle. You manage HDFC balance fund as well. And when you're managing balance fund, you have to take a view on interest rates. And just to make it slightly simple for our viewers, if you take a view on interest rates, you can really outperform that sector per se. So what is your view on interest rates, given that Reserve Bank of India has been consistently bringing the rates down?
So I think there again good news, bad news here. The good news is that inflation has come down, commodity prices are very benign. So that is putting a fair amount of pressure on interest rates to come down. On the other hand, if you expect that the economy will improve and demand will improve, that will put a countervailing pressure on interest rates to rise. And as the RBI governor has pointed out many times, India has still got a lot of supply side issues, and those supply side issues cannot get resolved in a year or two. They take much longer to get resolved from an infrastructure standpoint, etc. So I'm a little bit more circumspect in terms of my expectations of interest rates coming down. But I still think there is further room on the way down, but I don't think one should get carried away. So expecting rates to come down 50, 75 bips in the next year and a half, I think that is something which is reasonable. But I don't think it can happen much more in a country like India, which is supply constrained, infrastructure constrained. I don't think one can expect from these levels for interest rates to come down more than 1% over the next 2 years.
So if your view is that interest rates are unlikely to go down more than 100 bips at max, do you think it's time to even hunker down expectations from a balance fund?
I think you have to expect from a balance fund equity returns on the 75% which is invested in equities. That bit can give you 18-20% returns, which is a little bit higher than long-term returns of 17-18% because you're starting off at a low earnings base. So there should be reasonable earnings growth. And I think fixed income, you should see yields. You'll obviously get your return from yields and a little bit in terms of rates coming down. So all put together, if you get 14-15%, I think you'll do reasonably well.
Whenever there is a panic, whenever there is scares, whenever there is a problem like China, last year we were discussing Brexit, right now we are discussing Brexit. When these issues they come to fore, I guess historically that is the best moment to buy stocks. Would you say that right now that opportune time is over? That time was there, let's say closer to the budget, when markets were in a free fall zone, and after that we've seen a monster rally. So for someone who wants to time the market, maybe wait for that event?
So I'll start off by saying that there's a great saying that it's not timing the market, but time in the market which is relevant. So as I said, I think most investors get your asset allocation right, invest regularly, and as and when if there is a substantial correction in the market because of a certain event, take advantage of that and put more money to work. So if your question is, are we in the third category, is that the current opportunity? Certainly not, because there is no real distress that we are seeing. There is no Brexit has not happened yet, it's still an expectation. So if Brexit were to happen and the market were to correct substantially as a result of that, that is the opportunity. But markets have not corrected yet on any significant external event. Even China, the slowdown in China, we've not seen, we've seen the Chinese market obviously correct very substantially, but we've not seen, global markets really getting impacted significantly by China. They've had their own set of issues.
When I go outside Dalal Street, I sometimes fondly interact with some old timers, and one line I've picked up from one old timer is that ghar bech ke lena. So this is not the time to ghar bech ke lena. You would say the risk reward ratio is balanced right now. And if you're buying even a balanced fund, you should be prepared for some degree of downside.
Sure, absolutely. You should always be, I think, in equity markets, be ready for some downside.
So what could be the risk to this market?
There are plenty of risks, as always. So it's not just today, but it's, at any given point of time. No, so I think the India risk is that earnings take much longer. So already earnings have been pushed out by about a year, and now there is an expectation that they will recover in the second half of this financial year. So I think there's one risk is that earnings recovery horizon gets pushed out even further. Obviously, the well-known external risks, which is China, obviously has slowed down, but you've not seen any sort of calamitous event happening there. And if you're worried about the Indian banking system, can you imagine what is happening over there, where there is a lot more, the system is much larger, there is, one can argue, even more, it is more opaque than the Indian system. So I think that is something which can potentially be a large risk. And in general, interest rates are at historical lows across global economies. So that must at some point correct, and it's not certain or clear to me how that will play out. So I think a lot of these risks, it's interesting as we list these risks, a lot of them are outside of India. The China risk, the Brexit risk, the interest rate risk internationally, these are all international risks. I think in India the risks are coming down, the risks are already behind us. The environment is a lot more conducive, government is in place, commodity prices are benign and the rest of it. So a lot of these risks are outside of India more than within India.
For the better part of...
I'll just add,
yes,
I think the other risk that we forget about is valuations themselves. So
the biggest risk.
If you're starting off at the wrong point, then it doesn't matter as much what happens in the middle in our journey if you don't start off at the right point. And I think today in some cases we are paying too much. So I think that's another risk.
But for a first timer right now, and someone who's okay with a 10-15% volatility, maybe a 10% downside, but is looking at double-digit returns on a 3 to 5 year basis, is that achievable?
Absolutely.
And you think next 3-5 years the returns which you expect this markets could yield without getting into a range, do you think they could be higher than the historical returns?
The next couple of years I would expect that to happen, yes.
But eventually they would even out.
They have to. So long-term returns have to gravitate to a more sort of average normal level. But in the next couple of years, I think you will do better simply because, as I said, earnings growth have been tepid. You need to see faster growth. As the economy recovers, you should see that faster growth, which will result in better returns.
For the better part of 2015, this market was riding this hope phenomenon, whether it was internal or external, or whether a combination of both. But there was a lot of hope and hype in the market. Parallels were being drawn that this is beginning of a new bull market. Mother of all bull market has started. But do you think now expectations have come down and we are more reasonable?
I think expectations are okay. I don't hear, at least I don't see it on newspapers, I don't see it on your television channel that everybody is gung-ho that this is the time to invest, or vice versa. I think there's a reasonable group of people who are concerned and those who are optimistic. I think it's quite balanced. So again, I think when looking at it from a near-term standpoint, I'm not suggesting that the next couple of years are gung-ho fabulous years. I'm saying that they will be at average, if not better than average. I think there's reasonable risk that they're better than average.
As Indians, we are young, and that's our advantage, the young demographics, and that's where I think product differentiation also kicks in. So you're managing a retirement product, maybe targeted towards you and me. Then you got a product which is targeted towards safeguarding our children. So walk us through both the products, and they are diverse products, and you're managing two contrasting products.
Sure. So our children's gift fund is oriented towards people who want to save for a child's education or other requirements. So it's a balanced fund, 75% in equity, 25% in fixed income. It has a lock-in of 3 years or till your child turns 18, whichever happens later. So the money is long-term in duration. Our fund is around 1,000 crores in size, so it's reasonably small, which means we can take a good exposure to large and mid-cap companies. So I think a combination of having equity and fixed income, reasonable size, reasonable horizon, allows us to take long-term bets on stocks, and therefore should do well for somebody who's saving from that time horizon. The retirement fund is a little bit longer in duration. So the retirement fund has a lock-in period of 5 years. It has certain investment benefits under ATC. We have 3 options, so you can have a minimum investment of 20% and a maximum investment of 100% in equities, depending on which plan you choose. The funds are even smaller in size, so which allows us to do a little bit more in terms of small cap, mid caps, which will allow them to compound over a period of time. So it's a good product for a retirement standpoint, and people's longevity is increasing, and most investors don't plan enough for their retirement. and don't have enough of an allocation to equities, and you can't do you can only do so much with fixed income. You need to have additional risk and additional returns coming from equities. So I think that both products are sensible, one from a child savings standpoint and one from a retirement standpoint.
Really appreciate your time. So glad you could join us, and I look forward to such many engaging sessions.
Thank you, Nikunj.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.